Welcome to CFA Level 1, Equity Investment, Study Session 12 and 13. Reading 39 is the fourth reading in the equity investment, which focuses on different types of equity securities. The common shares represent the owner equity, and have voting rights in the general meeting. For callable shares, it gives the issuing company the right to repurchase the shares. Issuing companies would repurchase, if the share price is above the call price. We would also discuss this in alternative investment. For puttable, it gives investor the right to sell shares to issuing company. If the price is declining below put price, investor can exercise the right to sell share. In other words, in the puttable share, investors actually acquire protection from price declining. For preference shares, it ranks above the common shares in terms of dividend payout and distribution. More importantly, in the preference share has features of both common stocks and debt instrument. Like common shares, equity share is expected to perpetuate. Similar to corporate bond, preference share has fixed defined dividend. For cumulative preference share, it has right to accrues previous missed dividend. In the participating preference shares, it has the right to receive additional dividend, if exceed pre-specified level. Convertible preference share, it gives investor opportunity to convert preferred shares into common shares. That is mostly the case, when investors give up the fixed dividend and preference share, and convert to increase value common share. Equity change in value, whether upward or downward, is considered risk, and most commonly measured in standard deviation. For example, by having a puttable shares, the share is embedded with put option, which allow investor to sell share at a predefined execution price. Should the market price fall below the execution price, investor can sell share puttable shares. More importantly, the downside risk of falling price is eliminated in the puttable shares. For this reason, the risk imputable is lower than common stock. This slide is to explain various types of equity investing in foreign countries. The depository bank has the voting right. The depository bank purchases the shares, and subsequently put them into trust, and then sell shares as the depository receipt. Welcome to CFA Level 1, Equity Investment, Study Session 12 and 13. Reading 40 is the fifth reading in the equity investment, which analyze the industry and company in the competitive environment. In the industry life cycle, there are 5 stages in the industry life cycle, which include the embryonic stage, growth stage, shakeout stage, maturity stage and decline stage. With all these stages, it explains the characteristics and also the sales revenue. As examples, the question might be to test you in identifying characteristics in different industry stages. In the cyclical firms, it is correlated with the overall economic cycle. Because the economy is experiencing the business cycle, and cyclical industry would also experience high volatility and operating average. In the non-cycle firms, it is not correlated with the economic cycle. It either unaffected by the business cycle, or its high growth is independence from the business cycle. This slide is to indicate the factors could have an impact on pricing power. For example, high barriers to entry indicate fewer players in the market, and the remaining players could have a greater influence on the pricing, and thereby higher pricing power. High capital investment is leading to a high barrier to entry and exit. Porter's 5 theory is to analyze the business environment through, first, analyzing existing competitor. Second, the barriers of entry. Third, bargaining power of suppliers. Fourth, bargaining power of buyers. Fifth, substitutes that can replace existing demand. To the firm itself, it can continue to strengthen its position through being the leader at managing cost, differentiate its product, or focus to the niche market, currently being overlooked by the market. Welcome to CFA Level 1, Equity Investment, Study Session 12 and 13. Reading 41 is the last reading in the equity investment, which provide methods to evaluate equity. There is a total of 13 learning outcomes in Reading 41. It has been summarized in two parts with the primary focus to use various methods in valuing equity. As long as an investor buy the stock before the ex-dividend date, the investor would receive the dividend. If you buy equity after the ex-dividend date, would not receive the dividend. If you have the equity and sell after the ex-dividend date, you would still be receiving the dividend. In the preferred share, the valuation is the continuous fixed dividend payments D, and discounted by the discount rate, R. Because this is perpetuate payment, and the value for preferred share is dividend divided by discount rate. In the Gordon growth model, it is the valuation for common stock, and assumes a constant growth rate. If the holding of the stock is last for 1 year, it is the expected dividend or next period D, and price P discounted by discount rate R. It is the same case for valuing stock holding for 2 years. Meanwhile, the growth rate G can be derived from multiplying return of equity ROE with retention rate R. This model explains companies which experience high rate in short term and low rate in the longer term. Using this model would improve stock value estimation. In the price multiple approaches, it assumed the law of one price, in which two identical assets should have the same value. In that case, companies in a similar industry should have valuation. Using the Gordon growth model, we managed to calculate the value to common stock P0 dividing the price P0 by the earning, is the price to earning multiple divide price by the next period earning E1, is known as leading PE multiple, divide price by the next period earning E0, is known as trailing PE multiple. Dividend divide by earning represent the payout ratio, which is 1b. Another method to evaluate common stock is to use the enterprise value EV to earning before interest, tax, depreciation and amortization EBITDA. Enterprise value would capture the market value of equity, preferred share and debt minus cash. Deducting cash is essential, because we do not value cash withheld in the company. In addition, the earning before interest, tax, depreciation and amortization EBITDA is positive. That would address the PE valuation when the company is loss-making. The asset-based valuation is to value the company fair value of the asset. That could be a challenge to evaluate a company with a high intangible asset, such as branding value, and is mostly application to value financial companies, natural resources where the asset is determinable.